I have a few notes written down, but basically enterprise value is the true value of the company, and it's the value that is for like all investors, and then equity value is only value for shareholders, so it's more of like what the public eye sees. So equity value is less complete in a way. So if you're looking for which value to go off of for acquisitions, you would look at the enterprise value because it's a more complete picture, and that's essentially how much the acquirer will be paying for that company. Yeah, so now let's talk about how to get to enterprise value. So enterprise value, this is a pretty like basic, like not in detailed description of it, but basically enterprise value is equal to your equity value, and then add back, you have to plus debt, plus preferred stock, plus minority interest, and then subtract cash. So if I break it down, it's probably easier if I had a whiteboard or something, right? But I don't. So your equity value, and then I said you would add back debt because essentially usually most of the time, it's the person acquiring will, or the company acquiring will pay back the debt of the seller, so they have to take that on, so they will account that into the cost. And then we add back preferred stock because preferred stock is not really seen as common stock. It's seen more of like debt because the preferred stockholders have like a higher claim on assets, on the company's assets, than do common stockholders. So you'll have to add that. And then you'll also add minority interest because a company that owns over 50% of another company would have to report all of that company's financial performance as its own. So even though it doesn't own 100%, it will still have to report 100% of that company's like financial performance under its own. And then the last step is to subtract cash, and you subtract cash because the cash is like, it's a non-operating asset. So the cash is basically like given to the acquirer. Yeah, cash is, so basically like the equity value already includes the cash essentially. So that's a brief overview of the entire equation for enterprise value. Let's see, what else am I missing to talk about? Oh, okay, so is it possible to have a negative enterprise value? Yes, it is possible to have a negative enterprise value because there are like two options. One would be if you have a large cash balance, and then the second would be if you have a really low market cap. So some examples of that would be a bank. A bank has a large cash balance, so in this case, you could have a negative enterprise value. And then the second one is if a company is nearing bankruptcy. So that would show the low market cap and a negative enterprise value. But then if you ask if it's possible to have a negative equity value, that is not possible because you cannot have negative share prices or negative share like numbers. And then let's see what else to talk about. Okay, so if we want to account for convertible bonds in the enterprise value formula, right? So if the convertible bonds if the conversion price of that bond is below the current share price, then what we're gonna do is count them as additional dilution in the equity value. But so that's called like in the money. If it's out of the money, then you would count that part of the company's debt. And that's a brief overview of enterprise value versus equity value. Oh, there's a lot of you here. I'm surprised. Again, let me look through the comments really quickly. Hi, what am I doing? I'm talking about equity value. You understand nothing. Well, hopefully I explained it well enough. How old am I? I am 19. Hi, hey. You're smart. Thank you. I like Chinese. I like Chinese too. What am I saying? Wrong audience, I see. Yes, well, I'll be going off live right now, but thank you all for joining, and hopefully you learned something new.